Hi everybody, this is Gary Dean, and this is our nightly video report for Wednesday, April 27th, 2016. So the Fed, to say anxiety is past us. They basically cut and pasted what they said in March and put it in there. They added some, I don't know, something about the global economy, but it really made no difference. I kind of a muted type response. We did see a little spike higher, but that's just automatic now with every Fed meeting. But it's gone. Nothing has really changed as far as us being as overextended as we've ever been since 2009 as far as the internals, as you can see on the advanced decline line. Just moving down to the chart that, again, I will repeat over and over. This is a dangerous pattern for the bulls because you have the VIX at support and you have the S&P at resistance, and you have these bullish divergences on the VIX. So everybody is very, very complacent right now. Nobody believes this market's going to go down. Maybe they'll be right this time, but every time they've made that bet, when we were in this type of pattern, we saw them get absolutely crushed. And I just don't think that this time is going to be different. It's just a matter of when things start. Put call ratio, you can see we're still at low levels there. And finally, we have the bullish percent, which is flattened while the S&P is going up. So it means that now stocks are not, kind of following what the indexes are doing. So let's take a look at our regular charts here. And, we have the 5 waves up. The bears still have not pushed it through this 2075 level. This is the important line in the sand for the bears, because if they do that, there's going to be a reaction trade all the way down to the 2034 or even lower. Now, the fact that the moving averages are just crossing right now, typically what happens is they come down and test them, and that's going all the way down to the 2026. But like I said, we've been kind of going straight up as this was in a bearish pattern right now. And, we haven't made another new high yet. So if things do push down, what's going to happen is we are now going to finally get some type of little lower low on a daily basis. But if they decide to head up, you have to keep an eye on the 2012 and then this where is it? Right here, 2016. If they get above that, then we're, obviously making a move for the 2134. I'm sorry, that's 2121. But in any case, like I said, the just fact that they have zero gas in the tank, the fact that they are, riding this move higher on this bearish wedge that is, every time they've formed this, it seems to be getting exaggerated because, we had it here where, this time everything was different and, it broke down. Then, we had it this right here where everybody was waiting for the breakout, and from there it never came, where we had the 2150 lookers. So whenever you can see, like, we had this triangle was kind of slanted, then this went a little more up, this one is just exaggerated even more, and each time they've ended in complete sell-offs. And like I said, I don't know what's going to be the catalyst. What I do know is the Fed has really done nothing for over a year. They raised rates a quarter point, big deal. Does that mean that they're now backing the market up? No, they're going to try to talk it up the way they've been doing, saying, we may raise in May, and from this, what will happen is, in May or June, whenever they said it. But in any case, we're probably going to get a pullback just from that, even though it didn't look like one today. I think we are going to get it, and then when it comes that time frame, they're going to say, "Oh no, we can't do it. Things aren't lined up." The thing is that the Fed's never going to raise rates. They can't. Too many things are tied to these low rates. Everybody got married to them, and now they're stuck between a rock and a hard place, and they really can't raise them, especially when other central banks are going negative interest rates. So it's all talk about, because they don't want the market to get out of control, so they're going to sit there and hint about rate hikes and stuff like that. But like I said, I wouldn't be surprised to see the sell-off start real soon. I thought it was going to start, but this pattern is not sustainable. It never has. It never will. And we're at the resistance, and really the bears need to push it through to 2074. From there, I do believe that we're coming someplace into these levels here. But again, we just have to wait for some type of movement to the downside. Bearish divergences, kind of neutral on the SMI here. You can see we still, going all the way back to February, have not had a complete full breather or test of any kind of serious support, which would be someplace down into the 2036 level. And we didn't have any bullish divergences, and it just, these moves down are very fast, so they're not really catching their breath. Everybody that's that was short, that got stopped out, are not shorting again right here. They're waiting, so they're not going to get as much as the short squeeze that they've really had when they were moving this market up on this news about with the central banks and the interest rates. 15-minute chart, you can see we had this, we still haven't made it down to the 50% retracement spike after the Fed meeting. We're still within this zone until it breaks. It's anybody's guess, but I still think it's going to be breaking to the downside. So with that, again, not really much to even talk about, because we're still in the same situation that we've been in for the past couple weeks. And we need the bears to take it through the 2075 if we're going to see lower levels. Even if they head higher, I'm going to stick with, it's not a safe environment, because each time we've seen these types of moves, we've seen everything given back in a very fast manner. So with that, have a great night, and I'll talk to you guys tomorrow.